Hello, everyone, and welcome to our presentation tonight. I'm proud to announce I'm here with Scott from Advanta IRA, which is a self-directed IRA provider that can provide a self-directed IRA to invest in alternative assets such as real estate. And I'm Josh Gilmore. I'm a senior associate here at Growth Equity Group. And after Scott's presentation, I'm going to talk a little bit about what we do here at Growth Equity Group with non-recourse financing and asset-based leverage for IRAs. So without further ado, Scott, take it away.
Oh, great, Josh. Thanks for having me on tonight, and hopefully I can share with the attendees a little bit, some of those who are not familiar about how to buy real estate with your IRA. It's something that simply most people don't know about, that is possible and certainly legal to do with your IRA account. Again, just most brokerage firms are not allowing you to do it, and certainly more and more people are finding out about the ability to buy real estate in an IRA. So I'm going to go over just a brief overview tonight of how that works. There's a lot more information I probably won't talk about, but hopefully enough to kind of whet your appetite and get you interested in at least asking some more questions. My name, again, is Scott Maurer. I'm the Director of Business Development for Advanta IRA. I've been with the company over 10 years now. I have worked a lot in different transactions and helping people buy and sell real estate through their IRA and other assets as well. Spent more of my time the last few years focusing on the business development side of our company and lecturing, doing webinars, doing seminars, talks, really just to educate people about what is possible and what you can actually do with an IRA account that, again, most people just simply are not familiar with. My educational background, I am a licensed attorney, although I don't do any legal work on behalf of Advanta clients. That kind of leads me into our disclaimer. Just so everybody is aware of what self-directed IRA, a lot of self-directed IRA companies have followed the same kind of rules as well. But we provide education. We're very big proponents of educating individuals themselves, should educate themselves, educating other people on what's possible with a self-directed IRA. So we promote and publicize our events from an educational perspective. Now, we talk about legal issues at times. We talk about tax issues at times as it pertains to IRAs and investing in real estate and other assets, but we don't give any actual legal or tax advice. So if you need those types of analysis for your investment you're looking at making, working with an attorney, working with a CPA or a tax advisor, if you need a referral to one, we can certainly give you to help make a legal or tax decision. And also, we don't give investment advice, and we don't perform any due diligence on investments that our clients make. So with a self-directed IRA, it is up to you to evaluate the company that you are working with, the people that you are buying from, the investments you're buying, making sure you do your due diligence on those investments. Our job is simply as an administrator and record keeper. So when you're getting involved with a self-directed IRA, just know that those decisions on suitability of an investment and who you're working with, those decisions all are up to you. Now, just a quick background on our company. We've been around since 2004, and the only thing that we do is administer and do record keeping for qualified money. We'll go over what qualified funds are in just a moment. We don't sell any investments. We simply provide a service, and I think the benefit that our company has over some of the others that are in the self-directed space is we really focus a lot of our attention and detail to offering our clients a really superior customer service experience. We have dedicated account managers and a concierge service for individuals who work with us to get a one-on-one contact with the people that are helping them with the investments in their account. And we also, again, focus on providing just continuous educational content through our seminars, through our live webinars and live seminars as well, to really, again, educate individuals and help them make informed decisions about what it is that they're investing in. But just very quickly, some of you on the call probably have already heard of self-directed IRAs, but some of you may not. And why haven't the general public maybe more aware of self-direction? I think the biggest reason is that most IRAs, most old 401k plans are administered by banks and brokerage firms that offer you limited investments. If you go to a Charles Schwab or you go to a Fidelity, it doesn't make sense for them to tell you about and advertise that you can buy real estate in an IRA account because it's not something they hold. It would be very similar to going to a fast food restaurant, say McDonald's, and expecting that the person at McDonald's is going to tell you that for lunch today you also have the option to eat tacos or pizza which means you would then have to, if you decided on that, would have to leave McDonald's to go find those food choices. So similarly with self-direction, when you're looking for alternative investments in your IRA, if you're holding your account with a bank or brokerage firm, they most likely are not going to tell you about the possible investments that are out there beyond what they will hold. But IRS regulations do allow for a very broad range of investments. It's each custodian or each IRA custodian that can decide what it is that they're willing to hold. So you may have an IRA, you may have an old 401k account that is limited by what your brokerage firm is selling you, but certainly is not limited by the IRS rules, and we'll talk about that in a little more detail. Now, some of the main reasons I think people over the years have told us or told me specifically when I've met with them on why they're choosing to invest in real estate and other alternatives. And for some, it's simply a new source of capital. So you're looking at buying an investment property, a piece of rental property or rehab project. Using personal funds, you've done this maybe many years, simply using an IRA is just a different bag of money or a new source of capital for you to access. So you have 10 rental properties personally, then you realize you can use your IRA to buy more, and simply the IRA is just a new source of capital. For others, it's the tax advantages. When you invest with an IRA, the income that the IRA receives, the rents, the dividends, proceeds from a sale, all come back to an IRA tax-deferred or tax-free, so there's no impact to an individual personally for investing through an IRA with an alternative investment. And for many clients, more and more over the years, we're seeing individuals just want to have more control over their retirement accounts. They feel safer knowing where their IRA is invested and knowing what they have the ability to choose these investments rather than kind of waiting on Wall Street to pick them for them. Now, as far as the types of assets we see at Advanta, as far as alternatives that are out there that, again, some of you may not be familiar with, a lot of real estate, and it could be really real estate in any form, whether someone's buying a piece of raw land, whether they're buying a commercial property, whether they're buying a property to flip. It could be a very short-term deal. A lot of our clients, though, buy residential condos, single-family homes, duplexes, properties for long-term either appreciation and for cash flow on a monthly basis. So any type of real estate can be held inside of an IRA account. In addition to real estate, we won't talk too much more about them today, but we also see a number of other alternatives, people investing in LLCs, people investing in private notes and mortgages, you're basically using their IRA as a lender to lend to other people. You can do partnerships, movie projects, precious metals, just again, the list really does go on, because the IRS only limits you to a couple of investments that are not permitted within an IRA. So there's no master list of all the possible investments, simply a list of things you can't do. And we'll talk about that in just a moment. Now, as far as the types of accounts you can self-direct, again, this is where we get to talking about qualified money. Again, at Advanta, we can only hold qualified funds. Qualified money would include any type of IRA, whether it's a traditional or Roth kind of individual retirement account. If you own your own business or work for a small business, you may have a SEP or a simple IRA. We also offer solo 401ks, and I think the biggest one that gets missed a lot of times when talking about self-direction is any former employer's plan, whether it's an old 401k, an old 403b, a thrift savings plan. Those can also all be self-directed. So if you have any account listed on this screen, also ESAs and HSAs, but any account listed on this screen can be self-directed. It's just a matter of making the decision to move the funds and then taking the proper steps to get those monies moved around. The only plan that you can be restricted is current 401ks. As long as you work for an employer, they can restrict your ability to move the money, but some of them are allowing more and more people some flexibility. So you can always contact us or contact your administrator to find out what your options may be. Some people get confused when you have money. Let's say I have money in an IRA or the traditional or Roth at another firm. How do I get this in a position from where it's at a brokerage firm into an account where I can buy real estate? And the answer is very simple. You can do a trustee-to-trustee transfer where you move funds directly from one IRA to the other without the money touching your hands. And the IRS permits you to do transfers as often and whenever you'd like because they are non-reportable, non-taxable events. So moving money directly from a Schwab to a Fidelity account or a Fidelity to Advanta, the money doesn't touch your hands. It's considered a trustee transfer when it goes from one IRA account to another. It's a non-taxable event. If you have money in an employer plan like a 401k, 403b, 457, TSPs, etc., very similar to a transfer, but the term is just technically a direct rollover. And again, the funds going directly from that employer plan to the IRA without it touching your hands. And when you do that, again, that movement of money is a non-taxable event. So it's transfers and rollovers. Those terms are used interchangeably a lot, but it really just depends on where the funds you hold or where the funds are currently held to determine which option and which avenue you would take to get the money moved. Now, I mentioned the IRS doesn't have a list of all the permissible investments. They simply list the items that you can't invest in, and it's a very short list. The only two investments that your IRA cannot purchase and cannot make is you can't have your IRA buy life insurance, and your IRA cannot buy collectibles. But as far as investing in stocks, mutual funds, real estate, notes, private LLCs, etc., all of those investments are allowed because, again, the IRS only says life insurance and collectibles are the two investments that are not permissible. So in 1975, when they wrote the rules, they found it much easier just to place limiting rules rather than telling you all about all of the possible investments that you could make with your IRA. The other disqualifications the IRS has with IRA investments comes to who your IRA as its own entity can transact with. There are certain disqualified persons, and these disqualified persons are yourself as the IRA owner, your spouse, your parents and grandparents, your children and grandchildren, and spouses of those lineal descendants as well are all prohibited from either benefiting from or transacting with your IRA. In short, in the context of what we're talking about today in buying rental properties or buying real estate with an IRA, if your IRA buys real estate, it has to be buying it from some third party, somebody who's not on this list, and then the property does have to be for investment purposes. It can't be a property that you're looking at purchasing, that you then want to live in, you want a vacation. It does have to be strictly hands-off as an investment property. So what does this process look like? I'm kind of going to go through a couple of different scenarios using some of the same facts involved about how you actually buy real estate with an IRA account. And the person we're going to use is just a fictional person named Mike. He's got an old 401k account with 120 grand in it, interested in buying real estate. And he's really interested specifically in single-family homes and neighborhoods, maybe getting these at a good price, long-term growth potential, and good rental possibilities as well. So he finds two houses that are for sale at $100,000 each. So with the funds in his old 401k account, he has kind of two options. He could simply just buy one house and pay all cash and do a very simple transaction, or potentially he could buy two properties if he uses non-recourse leveraging. Sometimes when you mention the word non-recourse, people ask, what exactly is a non-recourse loan? Well, the IRS rules, again, name Mike as a prohibited or a disqualified person for his IRA, and thus he is prohibited from guaranteeing a loan on a property that his IRA is making a down payment on. So if Mike was looking at using his money in his retirement account to put a portion of the funds down and then borrowing the rest of the money, it has to be on a non-recourse loan. Again, a non-recourse loan, he can't guarantee the note personally, so the bank's only option if there's no payment is to foreclose on the property. They can't come after Mike, and they can't come after the IRA for any discrepancy. Now, the non-recourse loan is directly to the IRA. The IRA would be receiving rents, and the IRA would then be paying the loan out of the cash in the account. So the IRA is responsible for paying back the loan. Lenders who typically who will do non-recourse loan are wanting for probably 40 to 50% down, sometimes maybe less, with cash in reserve. Because these lenders that do non-recourse loans understand that their options are limited to foreclosure as a remedy. So in this case, they typically want a more substantial down payment. Not to get too technical, and this is something I can certainly discuss with people after the call or at a different time, but if you do leverage real estate with an IRA account, you do subject your IRA to a tax. Now, in most situations, the income that your IRA generates, so that's rents or dividends from a stock, that money comes back into an IRA without any tax implication. But when you do leverage real estate, your IRA is subject to a tax based on the percentage of financing involved in the property. And we'll go through a little example as we go through the continue going through the case studies. So how does Mike get started? The very first step for Mike, whether he's decided on buying one property or two, is to open up and fund his Advanta account, basically completing the IRA application that we have, doing a transfer or rollover of his funds from another custodian, and we'd have an account number issued for him in less than 24 hours and ready then for him to identify the property or properties that he's looking to purchase. When he goes to buy a property, it's important that the contract get written in the name of his IRA account. In this case, Advanta IRA, for benefit of Mike Smith, and his IRA account number is the legal wording that would go on any contract that his IRA executes to make an offer on a piece of property. Ultimately, Advanta will execute the contract after Mike has approved it and sent it to us, and we can issue an escrow deposit from his IRA to secure that property. Going forward, we will then work with any of the closing agents, whether it's an attorney, whether it's a title company, to make sure that all the documents, the deed, the HUD or the TRID statement, any notes or mortgages, etc., are all drafted in the name of his IRA in the red lettering above in the slide. And before we will close on a property, Mike will need to read and approve of all those closing documents. Once Mike has approved of the closing documents, decided which property he's going to buy, signs off, gives us his approval, we execute all the documents on behalf of his IRA and wire the funds from his account to closing. Property's been purchased, so Mike transferred funds to us without any tax implications, bought a property again without any tax implications because it's his IRA buying the property, and then now that the property or properties are inside his IRA, he secures his tenant and directs those tenants to send the rent checks directly back to us for deposit. Again, our job as a record keeper and administrator is to receive the rents in, deposit them to his account, and also any expenses that Mike has, whether it's the monthly mortgage payment, taxes, maintenance, insurance, etc., are also have to be paid out of the IRA as well. And again, our job as a record keeper is to pay those bills at Mike's direction. He can certainly track his activity online and through email notifications that our system will send to him, letting him know when money comes in or money leaves his account. So Mike can simply hold this property indefinitely and just continue to accrue his monthly rents. We've had many clients over the years that have seen the stock market go up and down, but they've continued to hold the same property, just receiving rental income and cash flow each month back inside their IRA. You can certainly do that, or if he comes across somebody who wants to buy the property and give him a nice little profit, his IRA can certainly do that, and the benefits are that the rents and any profits on a sale come back into his IRA tax-deferred or tax-free. So if Mike pays all cash for the property, what happens? Well, the $1,000, he's getting $1,000 a month in rent, that all simply comes back into the IRA, expenses are paid out, and the net return at the end of the year simply stays in his IRA, tax-deferred. If Mike finances, what are the loan details? Let's say that he put $50,000 down for each property and got a $50,000 loan at 6%. Over 30 years, he's looking at a pretty low monthly payment, especially if he's getting $1,000 a month in rent. It's a less than $300 a month mortgage payment that, again, has to be paid out of his IRA. So total yearly payments total about $3,500 or around $3,600 a year. Now, I mentioned when you do finance within an IRA account, so your IRA makes a down payment and you finance, that you do have a tax consideration. And now a really quick and dirty version of how the unrelated debt finance income tax would apply. If you had total monthly rents of $12,000, only $6,000 of that is going to be subject to the UDFI tax because the other $6,000 of rent is tied to his equity position in the property. And he put 50% down, so 50% then of the proceeds will come back into the IRA without any tax implication. So only $6,000 is subject to tax, and using the top end of the tax rate, he might pay a total tax of $2,300 on his $6,000 that was subject to this tax. He's got some net income, he pays the mortgage payment. The total income minus the taxes for this property would be $5,100 or so. And again, you can kind of see some of the calculations. Again, this is a very quick and dirty version of how this tax is implicated. Again, this is only for one property. There's no deductions or depreciation that would be taken to otherwise limit as well how much tax he would apply. So again, very quick and easy version. And again, this is one property. So if he's done this with two properties, the total income to his IRA is over $10,000 coming back into his IRA even after he pays the tax. And as he continues paying and continues getting the rents in and making his mortgage payments, the amount that would be subject to this tax would decrease in time as his equity increases. So ultimately the amount of money that's coming back in his IRA and escaping tax will grow over time, as opposed to if he'd simply paid cash for one property, he's going to simply have that same amount coming in each month minus expenses. So leveraging can make sense. It doesn't always make sense, but in many situations it can. This is an evaluation you would have with a tax advisor, and again, in a position where Advanta is not going to get involved with giving you advice. That's up to you and your accountant to decide if this type of investment makes sense for you. So getting started is fairly straightforward. It's a matter of getting an account opened, funding the account with a transfer or a rollover, and ultimately then choosing the investment and choosing who you're going to work with. And our team is dedicated to making this process as easy as possible for you so that you can understand it. Any questions you have, you'll have an account manager to walk you through every step of the way. And again, tonight's presentation was very short. We do longer seminars that you can always view at our website at advantaira.com to sign up for some of those events, some of those seminars, and certainly give me a call. If after viewing tonight's webinar you have more questions, please call me or email me. Both my contact information is on this slide. I'll be more than happy to go through some of this in a little more detail. Again, with the time constraints tonight, I can't get into too much detail. So I'm going to, at this time, again, encourage you to visit our website, reach out to me with any questions you have. And this time, I'll kick it back to Josh, who's going to share with you the information about growth equity.
Thanks, Scott. Appreciate it. I know a lot of the attendees we have coming on here are brand new to self-direction, inquired, and very informative info for somebody who's never self-directed their account and has questions on the process.
Yes, thank you. And it's again, not very difficult. It sounds difficult because people haven't done it before and because your financial advisor may not know about it, but it is actually very straightforward.
Absolutely it is, and accounts can be set up in a day typically, right?
Definitely.
Not something that's too much of an effort. Well, we're Growth Equity Group. We're nationwide real estate investors, and we've tailored a passive solution to self-directed IRA investors who want to own and leverage out real estate, but maybe don't want to be a day-in, day-out landlord where they're dealing with tenants and toilets and typical headaches of finding all the pieces of the right real estate and the right market at the right time. And for a lot of our clients, they're looking to escape this, the typical volatility you would see in the stock market. Up, down, it's an election year, it's not the safest place to have your entire nest egg tied to, and with how weak bond markets are and how terrible annuities are where you're locked in at a low rate and you can't get your money out, there's been a lot of growth in this space, and we're proud to be at the forefront of it. So our experience, we have 25 years experience as real estate developers, property managers, and investors ourselves. And our roots really are down to real estate development. And for a lot of our developments, we do full revitalizations and full gut rehabs. So we identify markets. We use 30 key indicators I will get into to identify a market we're going to invest in. And essentially, our model for success that we've perfected over the last decade is we do market evaluation on specific markets. Once we identify a market where it's currently the right time to buy, which I'll go over how we do that, we do specific asset diligence. So we're going in with our own working capital and purchasing 50 to 100 single-family dwellings in this market, typically in a distressed condition from like a bank or a large foreclosure. We'll go in, we will go in with our non-recourse lenders, and they will qualify these assets for non-recourse financing. We acquire these properties, we source the top management in the area after rehab and place tenants that pay us rent. This is when we introduce the properties to the client. So the client will be looking at fully rehabbed property, currently rented out, that makes the most sense for them, which I have a team of associates here who will kind of go through your goals, your risk tolerances, what makes the most sense to help you reach those goals without pushing you out of your risk tolerances there, and then give you a step-by-step walkthrough of our closing process. Once you close on the properties, you get set up with our GEG Manager, which I will show you a little bit later, but it's our intuitive software to check on your properties, and then we're with you from that acquisition to disposition. where we do annual evaluations on your property, keep you abreast of new developments before we release them to the general public. So you'll always have a first look at what we're doing versus if you're just to keep an eye on our website, you'll be getting a second look. Now, our model for success is being your evaluator. We do all the front-end diligence on the market and individual assets before investors come into play. We're your lender. We're not actually a non-recourse lender, but we work with non-recourse lenders and notice, a huge void in the space of available financing for investors looking to leverage out retirement dollars and get the most out of a real estate investment. We're your manager. We have on-site managers and then in-house managers that micromanage them, so we always keep you at a healthy arm's length. And our management goes as far as paying the monthly expenses out of your rental income, so you don't have to worry about writing checks for your taxes, insurance, property management, maintenance, things like that. And we're also your partner. We're with our investors from acquisition to disposition, and we're available 24/7 for any type of support, any questions they have ongoing post-closing with their investments. I had mentioned that we do have some software that's available to our clients. Once they close, they get a login and a password from our management department to log into our GG Manager, which you can check the site out as well. It's ggmanager.com. It's very similar to an E-Trade or a Scottrade. You can log in, see your account statements, see when the rent was collected, when the bills were paid, and when the net cash flow was sent back to your account. So really, you're going to get a statement on the 20th, and on the 23rd, you can confirm that the money from the rental income hit your self-directed account. Now, here's an example of how one of those monthly statements would look like. You'll see the rental income minus the expenses, and then the net cash flow that would then be sent back to your account. Now, for some of the markets that we invest in, we're looking into emerging markets that are growing and coming into their own, jobs, college towns for the stability of faculty and staff jobs that are well-paying and typically attract renters, and urban markets where you have a tremendous amount of business and movement to keep good renters in place and vacancy rates low. Now, to identify which market we're going to invest in purchase bulk real estate, we spend over $3,000 on what you'll see on the left, which is our analytics. And that's Case-Shiller Index. National Association of Home Builders is great because you can learn what it costs to build in any given market versus sales prices, CoStar, LoopNet, RealtyTrack. Those are just to name a few of the sources that we use. Now, doing diligence, there are very inaccurate free websites online such as Zillow, Trulia, Curbwise, Realtor.com. And what makes them inaccurate is they utilize algorithms and comparable properties to determine their zestimate or their estimated value. And when you're looking at a single-family home that was rehabbed versus a condominium that is in poor condition and needs a lot of work, Zillow doesn't take into account those things. They only take into account price and square footage. So you end up with people such as their CEO paying $1.5 million for a house he just purchased than the zestimate was, and also selling his property for a few $100,000 less than what the zestimate said it was. So that doesn't tell you it's inaccurate. I don't know what else will. But back to some of the 30 key indicators, here are some of the main ones. We're looking at building permits. Building permits being pulled for new construction paint a picture of what's happening in this market 2 to 3 years down the road. Cost of living. If the cost of living is low in a market, and steady and stable because of certain factors we're going to go over, it makes it very attractive for people to live and people to stay in. Vacancy rates. That tells you a picture of what type of vacancy you can expect over the 5 to 10 year term of holding a long-term investment, which is great for giving accurate projections, and we don't invest in the market with over 5% vacancy. That's one of our rules here. Major employers are huge, and obviously the stability of those employers. You want to be in a market where the biggest employers there are staples that are like a Disney or a ABC, something that isn't going anywhere anytime soon. And typically I go over a little more detail, but I'm actually going to show you on the property we're very excited to announce here tonight. We have our most recent development, our most recent inventory is in Orlando, Florida. which I know based in Tampa and that area, you're probably very familiar with what's going on in Florida. You know, it's a market that had 10.83% appreciation last year. It's 64% renter occupied, and it's under 4% vacancy right now. And it's a city that, you know, is named on every top 10 list for best real estate markets in 2016. So we're very excited to be there. It's been very, very hard to find inventory there. We've had our eye on Orlando for a few years, and the larger developments aren't selling because they realize real estate prices in this market are still 70% below pre-crash highs, and they have nowhere to go but up. We were lucky enough to acquire this development from an older gentleman who was actually the original developer from 1985, and it's getting to that time where he needs to hang up the boots and move on, and we were lucky enough to acquire a third of the development in one bulk purchase from him. So, as I mentioned, top employers, you know, you've got your staple Walt Disney World, which is the largest single-site employer in the country, over 74,000 employees, and they are not going anywhere anytime soon. Obviously, with so many small families, you have the public school system being second with over 53,000. And then another huge tourist destination is Universal Studios Orlando, which is over 20,000. And our development is actually about a 10-minute drive from Universal Studios Orlando and about a 25-minute drive from Walt Disney World, which is actually a little ways out of the city in the southwest corner. So a little more on Disney World. They have 47,000 average visitors per day, which is over 48 million annually, and they cover 43 square miles. You've got your Universal Studios as well, which recently opened up. A couple expansions there, so they're going to be hiring some more employees, and very steady, stable, popular destination. One of the largest universities in the United States, actually it's the largest by undergraduate enrollment, is the University of Central Florida, which is in the northeast corner of the city. It has over 11,000 employees, 52,000 undergraduates. It's a tremendous staple college that everyone knows their name. And you can see it just if you Google Orlando. As I mentioned, listed in the top 10 in pretty much every real estate investor magazine. You know, it's becoming a global hub for trade. There's conventions, multiple conventions in Orlando on a weekly basis. It's just a market that is seeing so much growth. It's amazing the real estate prices are as low as they are today. Now, healthcare is big there as well. Their fourth largest employer, Advanta, employs over 17,000 employees. One of their hospitals is 3.4 miles away from our development and going through a multi-million-dollar renovation. As I mentioned, appreciation rates are a big piece we're looking at, and you can see, you know, just how much in the last 5 years that 30% is not a lot over a 5-year period, averaging 5%, but this market's really starting to come into its own, with the last 12 months being 10.83%. And you also may notice at the bottom of the majority of our slides, we do have sources for this data that we pull from some of the paid services we use. So if you're curious, you want to verify this yourself, please feel free. And some of the trends in the market, some of what's going on in terms of rising number of renters and the median rent price. You know, it's currently averaging $1,300 a month, which is tremendous. And then you have your building permits. What you're seeing here, you know, the difference between 2015 to 2016, you see a very steady increase over time and then a huge jump this year. And that's big in part to the fact that 36,000 new jobs are being created this year, and developers are going out to meet this new demand. So when developers do this, and you can take a look at what these condos are being built at $160, $170, some even $180 a square foot cost, we can look at that versus what we are able to do acquiring, revitalizing, and reselling prices, and when we can stay a healthy $40 to $50 a square foot under that, we're providing great value for our clients. Some of the trends as well, you'll see here that vacancy rates continuing to decline under 4% currently, and average price per sale increasing steadily. The economy in Orlando is really outperforming the rest of the country by a lot. You know, it's stayed on a steady increase from 2012, where we've seen, you know, employment trends in the United States overall be tapering down as of 2014. And you can see on the right is a good chart of vacancy and how that affects your rental income. So as that continues to decrease and rentals become less and less available in this market, your rents will continue to rise. One of the things I wanted to mention as well, the properties are located on Sherwood Lake. And right next door is some apartment complexes that are very similar, very comparable in size to the homes that we have. Obviously a little bit less curb appeal, but they're renting $200 more than ours are currently rented out, the tenants who are there and have been there. So it gives us a lot of room to continue to get that cash flow up for our clients. Now, these are, as I mentioned, full gut rehabs. We acquired them from the developer, a lot of them anywhere from D to A class. We brought them all up to an A class, where some of the original electrical and plumbing were from 1985 and have been updated. There's a list of some of the things that we did as well. And as I did mention, healthcare being the fourth largest employer, Adventist, you have 2 hospitals, one going through a multi-million-dollar renovation, very close by, one 2.7 miles away and one 3.7 miles away in the other direction. So great for employees who work there, very easy commuting distance. We are also 2.3 miles away from West Oaks Mall. So that is always good to be close to that. It makes it very curb appeal to both renters and future buyers of the property. As with building permits, you see a lot of increase in new construction, which is a great indicator of the health of a market. We've got a view here actually in the background is of the lake that's right behind the properties, and you'll see in the distance is Colonial Drive. They're widening that highway from 4 to 6 lanes. And, a decade ago when we really shifted our focus to self-directed accounts and how we can help our clients with those accounts do the most, we noticed a big void in the financing aspect. As Scott mentioned, non-recourse financing is the only way you can leverage your IRA. You can't go out and get your traditional loan from your Bank of America, your Wells Fargo. And not many lenders offer non-recourse financing. It's just not a product that they need to offer. Why would they take more risk like a Bank of America, Wells Fargo, if they didn't have to? So what we've done is we've used our long-term relationships with commercial lenders to have our properties pre-approved with non-recourse financing before you even purchase the property. So there's no hoops to jump through. There's no qualification process because this isn't a loan that's based on you as an investor. It's based strictly on the value of the asset. And our lenders will finance new LLCs, individuals who are retired and are buying this on their own with no income, and self-directed IRAs as well. They're basing it off the condition of the property, the market it's in, the price it's being sold at, and most importantly, the income it generates. And deciding that this is a healthy cash flow, this property can pay off its own mortgage. Now, Scott did mention that there is a UBIT tax due, and that's due on every account except a solo 401k. And in a lot of cases, it can actually be a negative on a lot of our properties. On the property I'm about to show you, it's about $150 a year starting off the bat because you do get to factor in that depreciation and take a special credit per property. But if you compare apples to apples, a non-recourse finance property on the right and take it on the left with all cash purchase, you're going to see that even with that tax due, you generate a much higher return with a good cash flowing property with utilizing that financing. And all of our properties do come with a UBIT calculator. And the numbers obviously change. If you have a little bit more maintenance, a little bit less maintenance, and generate more income, the tax is going to change. So here you'll see what a typical non-recourse loan can do. Now this is a little more leverage than you typically get. Some of our lenders offer 66%, 2/3 leverage on the property, so you're only putting down 1/3 of the price. So this is a situation where you're looking at the same houses, 3 with non-recourse financing for $150,000 invested, and on the left you have one of those houses, $150,000 purchased outright. So you take $150,000, you buy this $150,000 house. It's rented out at $1,300 a month. You have no mortgage. Property taxes are $200 a month. Insurance, $40 a month. Management expense, 8% of the gross monthly rent, which is $100. Monthly maintenance expense of $40 a month, just short of $500 a year, leaving you at the end of the day with a net cash flow of $920, which annually is $1,140, and that $1,140 $11,040 is 7.4% of your invested amount back to you in cash flow. Now, you own these assets, and let's say the market just keeps up with inflation, which is 3.4%, and real estate is a natural hedge against inflation. If the property appreciates 3.4%, that is $5,100 in value. So your internal rate of return, your cash flow, and your value increase on the property is 10.8%. Now, what our clients can do on the right is utilize this leverage. So they would be able to buy 3 of these houses, each requiring a $50,000 down payment, and the lender finances $100,000 on each property, non-recourse. So they're purchasing 3 of these properties, and they have a $300,000 non-recourse loan. So they have triple the income, $3,900. They have a mortgage payment. All 3 mortgages totaled up would be $1,650 a month. Your property taxes are tripled, insurance, management, and maintenance expenses, and this would leave you with a net cash flow of $1,110 a month, which is $13,320 a year. So it's over $2,000 more in income for the same amount invested. Now, in addition to that, you're paying down the mortgage. You know, the mortgage is taken out before that return, and this mortgage is amortized over 30 years, very similar to how your home primary residence mortgage is, where you're paying more interest in the beginning and more principal in the second half. So even in what is the worst year for your mortgage because you're paying the most interest, you're still reducing the principal on those mortgages by $4,650. So your ROI, without factoring in appreciation on the asset, is 12%, which is higher than your entire return on the left. And now if you factor in appreciation at the same rate, that 3.4%, you own 3 times as much real estate, so it's not $5,100, it's $15,300. And, you know, in addition to the returns being exponentially different, exponentially better, you also hedge your risk. Because rather than buying 1 property, you're able to buy 3. Rather than having one being vacant and having to come out of pocket for expenses, you have 3 all generating income. So the odds of them being vacant at the same time are very rare, and we'll structure it where all the leases end at different times. Now, to show you a little bit about the pictures, these are attached single-family homes here in Orlando. Got some shots here as well. Full revitalization of the community. Just with the demand and how things are going, we're very, very lucky we were able to acquire these. And here's a site map. As you can see, we're getting towards the end of our inventory here in Orlando. If you're looking from top to bottom, the bottom is where the properties do meet the lake, and they are all on a slope. So walk out front of any of these houses, we walk down them all, you can see the lake from anywhere. It's very scenic, has a lot of curb appeal. Now, I mentioned the GEG manager at the beginning of this presentation, and we actually were blessed to win this award last year. It's called the Chicago Innovations Award for People's Choice, where our clients voted us in to win the award for our intuitive software. We also offer a rental assurance, meaning that any property you purchase with us, we will pay your rental income if for whatever reason the property is vacant and the tenant's not there. We will cover the difference. It's essentially us putting our money where our mouth is. We do run 4% vacancy on the little bit over 1,000 properties we manage for our clients who purchase them from us. And we also have some ebooks as well about some of the greatest challenges facing self-directed investors and prohibited transactions. And on that note, not to take up too much more time, I do have a few associates standing by, so if you'd like to give us a call, feel free to send me an email. That's my email there. And I also believe Scott and I are going to take some time to answer some of your questions. Make sure you got a good understanding of everything we're doing here. Let's see. Can I split this investment with another investor? Yes, absolutely you can. And it's pretty simple because we do the accounting on the back end. So say you have $1,000 of income, $500 of expenses, and $500 of net cash flow. And it's 50-50. What we'll do is, rather than send the $500 to one custodian, we're going to send the $250 to each one. So you keep the amount you put in to purchase the properties 50-50. The profits are split 50-50, both cash flow and final sale of the property.
Yeah, Josh, if I can interject too, we see a lot of, at times, like a husband and wife, maybe two people having a married couple each having an IRA account. That isn't enough for what they're looking to do with it. By using them together as tenants in common, they're able to accomplish that. So we can certainly handle that as well. And then you're really only working with one custodian, just two different IRAs funding the deal.
Nice. Good point. Good point. Do I actually own a property, or do I own a share of all the properties? You own an actual property. So this is a deeded individual property. Simply put, we're going out, we're buying 100, and you're buying 1, 2, 3, 4, 5, whatever it is, actual individual deeded pieces of real estate. I got a good one for you, Scott. Who gets the deed? Do I get the deed?
Well, not the individual doesn't, because the IRA owns the real estate. The IRA, your IRA is a separate legal entity from yourself. So your IRA itself, your IRA gets the deed. So the deed after closing ends up coming back to our office to be held in safekeeping. We can certainly give you a copy of it. I can't know exactly our policies. We may be fine as well with you having the original. I don't think that's something we have to keep necessarily. So, but the deed is titled to the name of your IRA as its own entity. That's what keeps it tax protected.
Nice. Here's another good one. What other markets have you been invested in, and how have those gone? Well, we've been invested in over 15. Some of the more recent ones, we were big in Virginia over the last 3 years with the port growth there. We've been in Omaha, Nebraska, which I personally own a property there from Growth Equity Group that was called the Silicon Prairie. They're stealing a lot of the tech business from San Francisco, Silicon Valley area because of the low cost of living and the incredible infrastructure they have there to keep everything low cost. Texas, we've been big in Dallas, Houston in 2011, 2012. 2010, we were very big in Miami, Fort Lauderdale. You have your Fort Myers, Florida, all markets that, we were able to find a lot of properties that went under. Let's see here. This is a good one for you, Scott. Can my mother's IRA make a loan to my LLC, as it is a separate entity from me as an individual?
Unfortunately not. The IRS rules would say for your mother's IRA account, the disqualified persons and entities would include you as her son, as a lineal descendant, and also then any business that you own or control. So your mother's IRA could lend money to anybody else, just not herself, your father as her spouse, and then you or any of your siblings as her children. So, and that again includes any entity. So you could look, instead your mother's IRA could partner with you if you had cash and your mother's IRA had cash, rather than having her lend money to you, which would be prohibited. You could explore simply her IRA and then you personally joining up as partners on the deal. Kind of one of the first things that Josh talked about, the first questions, using an IRA as a partner, that could be done. So it's a little bit different scenario than having her lend money to you. Instead, both of you being an equity partner in the particular piece of real estate.
And I got another one here. Can only IRA funds be used for non-recourse leverage? Can non-IRA funds be used? Yes, they absolutely can. The financing isn't based on the entity purchasing it, but on the value of the property and the income it generates, and a few other factors, obviously. But the loan is pre-approved. We have clients, probably about 20% of our clients are buying these either in an LLC or in their personal name outside, just as a different investment. So it doesn't have to be all IRA funds that purchase this investment. The loan is pre-approved regardless of that. Let's see here. When do we sell the properties? Well, that depends on you personally. You know, we tailor our strategy to be a fit for our clients. So some clients are retiring in 5 years, and we structured a portfolio where this gentleman bought 5 properties from us, and he's planning on selling 2 of the 5 when he does retire and using the income from those 2 sales to pay off the other 3 mortgages, and then he's going to keep the 3 properties essentially till the end of time to generate income for him without a mortgage payment. Will be much higher income that will help him offset the fact that he cashed his last paycheck and he'll be getting a lot less income, you know, from Social Security versus when he was working. So it really depends on you as a person. You know, there's no set time limit. It's your property. You can sell it the day after you buy it from us. But if that was your mindset, I would say don't invest with us, because this isn't about buying and selling. Yes, the sale is important. Exit is very important. But this is about long-term buy and holds, where you're utilizing the income the assets are generating to pay off the mortgage. And one more note on the UBIT, as Scott mentioned as well, the more you pay that down, the less your UBIT will be in theory, because you are a less leveraged asset. 50% equity versus, you know, 75% equity in the property goes from 50% of that being taxable to 25%. And let's see here. I've got time for one more question. How does the insurance on the properties work? Well, there's insurance policies obviously required by a lender, and we wouldn't want you to not go without insurance. That's not a very prudent investment decision. But the insurance works in different ways in different developments. So for Orlando example, there's one master policy for all 52 units, and every owner pays a portion of that. And when we're able to do that, it's actually great, because it saves all of our clients money, because they're getting a discounted insurance rate for having such a bulk insurance. You know, 50 properties, they're going to give a discount versus if you were to just get insurance for your one property. Now, for different, we have multifamily buildings and some single-family homes, and in some of those cases, the lender will have a master policy for all of them. In the multifamily's case, it's typically individual insurance per the building. So that's a policy you'll have to take out before closing, and it'll have to be proven to at the closing table that you've paid your insurance, so before the lender will finance. Now, you're not really left on your own. We have a broker we work with that's very familiar with us, gives us good rates, and you don't have to use them, but I'd say 90% of our investors do, because they end up saving money. Who manages calculating and paying tax? In the Orlando portfolio, we escrow the tax for you. It's calculated by the county. It's not calculated by us. And you will get an email about that as the owner, or sometimes the custodians will get the email and forward it. But you can typically contest the value. Usually it's something that's not worth your time. You're saving yourselves, you know, $3 a month by contesting the value. But that's really how it works. And in Orlando, we pay that for you, and you'll see the expense coming out of the income. Okay, I think that wraps it up. My email is there, and you have Scott's email as well, so if you have any follow-up questions, anyone. And appreciate it, Scott. It was great doing this webinar with you, and I look forward to doing some more down the road.
Yeah, definitely. Thanks for having me on. Hopefully everybody got some really good information tonight from both of us.
Definitely, definitely. Well, look forward to many more, and I wish everyone a good night.